Welcome back to my channel, everyone. Thank you for tuning in. And in this video, I want to introduce and make a video on, and I go more in depth with this in the new video lessons that I'm adding to the course, but I want to make a video on market context and how important it is to understand what market context is to our trading. And, us as traders, we have to trade as discretionary as possible, meaning, every day is different. So every day we have to trade differently according to basically the clues and the signals that the market is telling us and what the market is basically giving us. So I posted this on my Instagram story the other day. Basically says that everyone comes to the market every day thinking it's going to be identical to the past. It doesn't work like that. There are an infinite amount of variables that are going to affect your time, the price, volume, momentum, the type of orders that are going through, your competition. These are just some of the variables that change on a daily basis. Your key as a trader is to adapt like a chameleon. Your trading should not be the same as it was yesterday because of those variables that might not be the same. And the key is to identify that and react accordingly like a chameleon. You have to adapt. The size and the extent of the trades that you put on should be based on the market conditions and the context itself. You have to be flexible as a trader, not constant. If you are constant and you're just moving forward in a steady line, doing the same things you do on a daily basis, then most likely trading is not going to work out and the odds are not going to be put in your favor. You have to be flexible and adapt to what the market is telling you, basically. And that's basically having a discretionary mindset. Do not be constant. You have to be flexible. And I'm going to explain what that means. Now, this is also on my Instagram. So if you aren't following that, I will link this in the description below. Definitely worth a follow. So no one's going to ever know exactly what the market's going to do next. Us as traders, our job is to take trades where the risk is in our favor, it's tight risk, and where areas where the market could possibly turn or break out, whatever, depending on our trading strategy. But the market context is going to basically tell us how to trade that day and what we should be looking out for, the size of our trades, the mentality. Are we going to look to take profits fast? Are we going to look to hold if it's trending? So it's basically going to be very dependent on the S&P 500. The stocks that we trade on a daily basis, Microsoft, Netflix, Apple, Facebook, Tesla, all the major market leading stocks are going to be very dependent on what the S&P 500 is doing and what the NASDAQ is doing, because those are basically the overall markets, and the stocks that we do trade are just the bread in the basket for the actual indices. So I have a little study on here, which is the days range versus the ATR. And this study I have linked actually if you want it in one of my other videos. But this is going to tell me my days range. S&P moved in a 30-point range today compared to the average true range, which was 49. This is talking about from pre-market high to pre-market low because that was our high and low of the day. But I'm really only concerned about the regular trading hours from 9:30 to 4 p.m. Eastern time. And this today moved in a 15-point range today. So 15-point range on the S&P 500 is nothing. And you're not going to know this when the market opens. Before we see any price action, you're never going to know this. It's only going to develop, and we're going to get these signs and clues that the market is going to be trending. Because obviously you could see today was a trending day. There was no follow through, light volume, very tight, very balanced type of day, no clear direction. You're only going to be able to understand this as the market is developing and as price is actually trading in the future. So before the market opens, I would have never guessed today would have been a trending day. I mean, yeah, you could argue that the past 3-4 days have been trending day, balanced days. But we're not going to know if it's a trending day, a balanced day, an imbalanced day. Are we straight up, straight down? Are we going to chop? So when the market is like this, like I said, the stocks that we trade are going to trade choppy and very similar to the S&P 500, where if we do break out or we do reverse, there's going to be very little follow through accordingly. So you have to always keep the S&P 500 and its context in mind. Like I said, you're never going to know exactly, but you could have good clues. Let's just say, I don't know, the first hour of trading, this is what price looked like. Very flat. The first hour we moved in a 10-point range. 2-3 weeks ago, even a month ago, we were getting 10-point ranges in a 5-minute candle period. So break above the highs, we fail, come back down, don't break the low, then we break above the high, no follow through, we come back down, make a higher low, then we break above the high, no follow through, we come back down. Very choppy type of day. You're still making higher highs, higher lows. So yes, the trend is up and you could argue that, but look at the volume, look at the follow through. There's just nothing like that. So I'm going to reference now the trade that I took today, which was on Microsoft. When the market is trading like this, where it's choppy, sideways consolidation action, it's fine. There's a couple options that you could do here. Either don't trade at all, walk away, save your mental capacity, your mental capital for another day. Market's going to be here tomorrow. It's always going to be here tomorrow. 2, you could size down. We had a 4-hour supply on Microsoft today. Took this short myself below 209 after we rejected the supply. And I had a target of 207.60. And we came to 207.60 pretty perfectly. But I'm going to explain to you what I did, which protected myself a little bit. So when a market, and I realize this, when I'm talking about the market, I'm talking about the S&P 500. When the market was trading the way it was today, I take my profits fast or I size down. Reason why I size down is there's a lot of fake outs and the market could reverse up, reverse down. It's a Friday today. You can get burned with theta if you're trading the current week's expiration. So that's another thing too. On Fridays, I trade the next week's expiration if I'm not scalping. So like I said, there are tons of different variables that are going to affect your daily trading decisions. And the best way to get better at it is through screen time and experience. That is the only way, because you're going to be able to recognize different things and how different scenarios react to other different scenarios, basically. So Microsoft took this short below 209 after rejected 4-hour supply. This was a pretty perfect trade. I actually had this in the pre-market plan today in the Discord room. But, we came up to the 4-hour supply, rejected pretty perfectly, and then we came down, and the market then in a 15-20 minute period was just sideways. It was chopping, and there was just basically no follow through. And this was at the same time the S&P 500 was breaking above the high and just was not moving at all. So right then and there, that's giving me my context. That's giving me my flexible mindset to try to adapt to what the market's telling me and take my profits fast. We came down to 207.60, which was a support zone from I think 2 days ago or yesterday, and I took off half profit. So like I said, trade small or take your profit off when you have it. I took off half profit at the 207.60 point and I entered at 209. So my break even point, or not my break even point, my stop loss now was originally at 209.60. So 60 point risk to make $1.50 isn't the best, but I'll take that. What I did was, after I scaled out 50% of my position, I boosted my stop loss lower. So now this trade can never turn red on me. Yes, it was a big winner. It was like a 70-point winner down here where I took off half. And then when it reversed back up, it was about break even on the remaining contracts. So I took off a decent amount here, boosted my stop loss lower just to protect myself. You have to be able to adapt. And I got this clue from basically what the market was doing. Again, now if you're trading the S&P 500 and you see this, so I love trading the S&P. I'm a big S&P trader. If you see this, break above the high and no follow through, that's a red flag in your mind. And, you should sit back, sit on your hands. Don't catch FOMO. Don't take stupid trades. The market is not ready for you to trade. Your setups that are going to come are not going to be high quality. We did rally into the 4-hour supply zone up here, and we did reject and move down into the 30-minute supply zone. So I'll show you what the 30-minute supply zone looked like. It was from this candle right here, was a 30-minute supply zone. We moved down. And for the pajama traders, the traders that trade overnight futures, the market dropped all the way down, bounced perfectly at this daily demand zone. And if you were to take it long and short and play the closest supply to the demand zone, it would have been perfect from daily, take profit at supply. We're in an uptrend, obviously, so you long at demand, take profit at supply. But you could have shorted the supply zone if you really wanted to, which would have been a good trade, and rode it all the way down into this 30-minute demand. So I hope this cleared up some context. Like I said, I go in much more detail in the video that I created to the course. I will be adding it to the course this week. It's a good one. There's some clues and stuff which you can use for market context. So I hope this cleared it up a little bit. Drop a like on this video, comment, and subscribe. Thank you.